part of why I was interested in having this conversation is, one, I feel like you've kind of chosen two hills to die on.
This is actually a great way to start. That feels true. That feels absolutely true.
And they're pretty related.
Okay.
But I think they're maybe related in a less obvious way than it comes across at times.
Okay.
Because I think one of the hills you've chosen to die on feels very get off my lawn.
All right.
Could you agree with that? I mean,
I think the best criticism.
I would say in a vacuum, it feels like get off my lawn. That is not venture capital.
Go on, but maybe I'm the first 43-year-old grumpy old man in Silicon Valley, which would be.
No, you wouldn't be the first. You wouldn't be the last. I'm just saying like this.
Okay, fine. One is the get off my lawn.
One is get off my lawn. This kid. This isn't venture capital. I don't know what you're doing, but it's not venture capital. Okay. And then there's another one that I actually think has a lot more nuance, but it's also harder to articulate than get off my lawn, and that is there's a ton of both human potential and financial capital that's going to waste on terrible ideas that have no business raising funding. I think those two are completely connected.
Yes.
But I also don't know that in anything you've written or any of your tweets, the dots get connected terribly well. And so why?
I'm not sure, to be honest. They're terribly well connected in my head, so it's going to be interesting to try to connect them.
Despite the fact that you've been iterating on them so long, and like I know like I said, these are hills you're choosing to die on.
Yes.
They're important, and you're important to me, and I think you're important to this ecosystem. And so in acknowledging that you have these ideas that are important to you, part of what I want to do is just figure out what they mean, why that's the case. And hopefully when we're done here, we've got something actionable that an entrepreneur can look at and say, okay, the thing that I'm about to spend both years of my life putting at risk my own personal finances and my own opportunity cost, is worth it. Is that fair? Is that the right framing?
Yeah, I mean, I think there's like more hills I will die on because I like finding hills I believe on. But like, I think those are two of the things I believe most strongly that are probably not deep conventional wisdom these days. Or
pulling it forward to today, these are not new ideas for you. These are like, was there an experience? Was there a moment where you're like, we've got this wrong?
I don't know that there was a big aha moment. I've told people I think one of the things we're pretty good at Slow is like being honest and learning both to ourselves. And so I think when we started looking at iterations of cohorts of investing over the last 8 or 9 years, I think that was one thing you start pulling apart. I'd say
when you say cohorts of investing, you're talking about specific Slow cohorts, or you're talking about
the ecosystem, things we were close enough to that we understood the specifics, right? Yeah. And so I think like one of them came from decoupling this idea that an awesome product makes an awesome company, which makes an awesome venture investment.
Right.
Which, listen, I like have more stock picker than product builder in my soul, which is another thing to talk about. I think that's most VC should, but I had a hard time conflating those as like equals, right? When they are.
And what you had a hard time connecting was great products win.
Well, yeah, it was shorthand for a bunch of things. The idea is like, it can be an awesome product and not be a great company. And it can be a great company and never call for venture capital investment, right? Like it's a very specific narrowing of the funnel just amongst our own internal conversations that's slow over the years and trying to understand, right? Because you can go back and look at awesome products that were terrible companies and terrible venture investments, right? So there are counterfactuals. There are awesome products that are awesome companies that never needed, called for, or could have used venture. So you can start teasing apart and realize.
Was there a specific company in the Slow portfolio, or was there a specific cohort of companies?
No, I think it was
just Slow or otherwise, just to say like, oh, that is the counterfactual to this prevalent idea or conventional wisdom in venture.
It's a good question if I can call. I'm always bad at calling out immediate names, but
okay, we can beep it out.
No, but like something like GoPro is very debatably a great company.
Yeah.
Right? I mean, it had a very high run, lots of revenue, but like from a business fundamentals after this long of being in business, it's hard to understand is a super high quality And when I say company, by proxy, I mean like great business model, like economic characteristics, all that stuff.
Yeah.
Pretty debatable at this point, right? What it really is from that. I mean, I think it was a great trade if you bought in early and the momentum carried with the brand, but it's like hasn't resulted in an amazing company. And so I think that's something that everyone would agree was an amazing product. What's
the market cap on GoPro these days? Have we looked?
I want to say it was slightly bigger. I want to say 700 or 800 million, but still. It may even
because this also goes to that broader point of market cap is 236 million.
After how much equity raised?
That's what I'm saying, and I think that goes to the kind of more precise definition of what a venture outcome looks like.
Well, and I think
these days too, right?
Yes, I mean, but I think this is how do I get to the hills I ended up dying on was first this like decoupling awesome products from awesome companies and awesome companies that require capital. When is the venture capital moment in those companies? And that we don't have to shoot that many bullets, like pretty well aligned. So I think if there was an aha moment of like having to define venture capital for myself so I could practice it every day, it was probably in that discovery of like really unpacking 7 or 8 years ago the decoupling of awesome products from awesome companies and awesome companies from awesome venture capital investments and trying to figure out, can I build some system framework, some way of thinking? I mean, some book of blackjack, right? So that when you see cards, you at least have a sense of what the odds should be, and then you can do whatever you want with it. So I think that probably started me down the rat hole of both these hills. And I think the first is related to the second, because the more you begin to understand what I'll define as venture capital, you start seeing mismatches in what's going on with founders, how they're spending their time. So I think that's kind of what led me down this. And I think simultaneously, you're meeting with founders every day, some of whom have already raised, some of whom are in flight, have invested their time and money into these things, coming to you without a real sense of how to deploy the capital, looking for guidance on what the core thesis is, right? And realizing that there was some discovery work left undone in the rush to fund the company to start it up, and some things that probably were knowable up front that the market didn't spend the time doing. So I think that's probably the other embedded in one of my crazy beliefs is like, I actually think a shit ton is knowable early on in a company's life. And I don't think it should be like this, there's 30 mysteries we need to go solve in order to end up on the mountaintop we want to climb. I think it's like, the odds you solve one mystery are pretty low. You know what I mean? You start talking about solving 2 mysteries concurrently in a short time period, like the odds go up exponentially. Let's make sure we're picking the right mountain to climb.
Right.
Let's plan the most like realistic route up, given everything we know about that mountain, and like let's not make the summit because a storm moved in. You know what I mean? Not because you ran into a cliff or into a canyon you didn't plan for. So I think that's like the other strong held belief on the hills I'll die on is like I think a lot is knowable up front.
What's interesting is when you first started having this conversation, it immediately took me to any number of founders who I meet, and my immediate reaction to the pitch is something along the lines of, you're better than this idea. Like, you're good, this idea is not great. But in evolution of venture, there are so many examples of companies who started down the wrong path, had the magical pivot, and they get exactly to where they need to be. So they end up using money or starting down a path that is taking them in the wrong direction, but that ultimately they end up correcting for down the road. You're suggesting, though, with this that they could have known, they could have avoided steps 1 through 5, they could have avoided the pre-pivot of the journey, or no?
It's not even about not avoiding, right? I think it's being very honest about the DNA of what you're going after, right?
Yeah.
And saying like, what are the odds? What are the payouts, and what's it cost? Right?
Yeah.
And so I think we obviously think like the point of venture is around experiments.
Yep.
And I think you can be much more thoughtful about what you're actually testing, such that 2 things you can get when you get a false. You know what I mean? 1, there's signal in your experiment, so whatever output you get, you can trust. And 2, when you get a false, you get it fast, you get it efficiently, and then you can decide what you can then more intelligently deploy. Here's the crazy thing to me. The biggest asset going into these companies is a founder's opportunity cost. These are people who, like, whether they're getting it or not, probably command pretty high rates from the economy in general. And as soon as you take money and incorporate, you're doing it for 3 years. But yeah, by the time you spin up a C Corp, fund it and spin it down, it's going to take 3 years of your life. So you're going, these are like people who get $1 million of RSUs, maybe more. I mean, at a minimum, you're talking about $3, $5, $9 million opportunity cost investment decisions. Mm-hmm. And what everybody agrees is like the most volatile asset class, high failure asset class there is. And they're doing it with very little structured investment, judgment, wisdom, and guidance. So I think like a lot of my experience at the time, it led me to that point of like, that just doesn't make sense. I don't know how much I fully believe this, but I kind of do, which is I actually think the abundance of capital might be a bug and not a feature for founders, at least as it relates to like high ROI opportunity cost investment.
Say more about that.
When there wasn't any venture, right? When this was like a cottage industry nobody cared about, parting with your venture, like venture dollars were much closer to the cost of opportunity costs, right? Like they were scarce, you didn't have a lot of bullets, you couldn't just go back and reload more bullets. And so when a founder met with a VC and the firm said, yeah, we will part with our capital, it was pretty high signal. Not that it was going to work, but it was pretty high signal that it was probably worth the founder's opportunity cost to go pursue that endeavor, right? And so for years, founders took signal, kind of by proxy, and it makes sense. Founders are unbelievable at having an advantage of like, how's the world going to work in a very specific way in 15 years? What's built against that world? How do you build it, right? Like that's actually where their alpha generation comes from. Mm-hmm. The rest of the questions on value proposition, market dynamics, moat, quality of business model are like important, knowable things, but much more objective than this. And so you had this really perfect balance when venture was super expensive of founders could play in this area. The investor side would it's why diligence took a while. They had to dig in for a couple months to really get it. But when they did, the founder could take signal that they should quit their job, go on this pursuit, right? And if it's true, great, happily ever after. It's false, you're quickly back to what you were doing. Does that make sense?
Yeah, totally.
The cost of capital goes down, which inherently brings the signal alongside that capital that can founders take comes down, but founders still trust it at the same rate. And I think that's kind of what led us to where we are, which is and everyone's well-intentioned, right? These are not malintent people, but when the opportunity cost of capital goes down low, but founders doesn't, you need some countervailing mechanism to make sure, right, to help them.
In fact, it might be the opposite. Their opportunity cost has gone up because all those RSUs, all those salaries.
Yeah, I mean, I would say that their time's even more valuable now, right? But at minimum, it stayed flat as that's gone down. Yep. There needs to be some countervailing force, option, wisdom to kind of recreate some of that respect and scarcity for their time. Does that make sense?
Yes. How does that insight distill down to something actionable either within Slow or actionable to the entrepreneur you're now evaluating?
One, you got to buy off on that concept, right? So there's a fun data of
yeah, and I'm sure there's plenty of people who said that it's just all unknowable.
Well, this is what I say. I think two things, which is any capital is signal. Okay, fine. That could be a position you take. And yeah, well, nothing is knowable. The universe is open-ended, to which I can be great, that's an approach. I think this has resonated with people because I'm not saying it's all knowable.
Sure.
Right? There are mysteries, there is creativity, there is subjectivity that's inherent in every great company. My point is that actual surface area is pretty narrow. Mm-hmm. And it's surrounded by a bunch of land we can kind of map out pretty well if you're correct about the creative part of the business.
Okay.
You're saying what's actionable. We call it the Slow PhD.
Yeah.
My partners hate the branding. I don't know if that's right, but it's honestly what the output became, right? So I'm spending I think the backstory is helpful here, which is I'm spending all the time, earlier in my career, spend time at the later stage, increasingly going early stage, trying to understand kind of underwriting frameworks, and knowing that I was always pretty good at going, all right, year 5 to an S1, right? What is that map of dominoes fall? How do you trace the path from here to independent company?
Yeah.
And so going, all right, we know we want to back things that have more than 0% chance of going public. You kind of have to if you're an early stage venture fund. Let's start there. But we know that is just a series of things that have gone right. That's a series of hypotheses that have proven correct. Right. Can you just kind of reverse engineer them in some order and go, what things do I have to believe are true for this end story to be true? And so that kind of became a bit of an underwriting framework, how I'd approach founders and whatnot. And I increasingly would
Did it change how you were evaluating them, or did it change the kinds of things you were investing in?
Yeah, I think it did. I mean, I think once you start really trying to be critical, is there more than a 0% chance this company can take an earnings call, and what's the story when they do?
And you're looking at this at seed Series A.
Yeah.
Yeah.
just trying to see, can we knock over some, and we can imagine, this is like not hard and fast, but like, is there a world you can imagine where they knock over enough dominoes, right? Are they in a space, in a product category? And none of it's perfect. Everyone's got to have their widget for getting to a decision. But I was increasingly calling that the dissertation. And I was like, kind of like a dissertation ends up being the sum of a bunch of other hypotheses.
Yeah.
You stand up and deliver it, right? And you defend your data. And I was like, that kind of feels like a roadshow. Like, it's not that far off. So I was using that terminology and getting more comfortable with it and into it, right? And so you finally are like, all right, what am I really? Meanwhile, this opportunity cost stuff is happening. You're meeting with more and more founders who are like, hey, I started here. I'm not sure that's the area. Where can I go, right? And you're kind of meeting with founders that are, or you're like, hey, that's the fourth time I've heard this story. Let me tell you what troubled it in the past. Like, you could have seen this in diligence if you spent more time. I was like, I wonder how PhD program, like, I should take a couple days and like, I keep talking about PhDs. What do I really know? And the TLDR, my takeaways at least, is for 250, 300 years, they've been really well-defined programs with really two goals, which is like increase the odds that someone is novel and correct about how the world works, and then put them on the most efficient path in terms of resources and time to get a yes or no, a true or a false. That's kind of what we're all doing every day, right? And it really comes as like, I think the only reason you stand up any organization, a nonprofit, a pizza joint, a shoe company, AI dev tools, is because you believe the world works in some novel way, right? And so I started going, yeah, that's like, to me, feels like what the job should be of any net new organization is trying to maximize that loop. And you go, well, so do they just let people wander around and come up with their dissertations on their own? They're like, no. What they found is like,
get your advisor.
Get a master's degree, right? So depth and breadth matter. Depth and breadth, they've learned, matters, right? It informs odds over time.
Yep.
Also being able to think differently and critically, right? So you can't just get a master's degree, right? Because then you won't find a novel way the world works. But then they're like, come on campus and don't give us your dissertation right away. What we're gonna do is surround you with the resources so you can iterate quickly and figure out what's novel or not, what's possible, impossible, and iterate around those. And even when you find a loop that you're really passionate about on that front, right, with contextual advisors who may not come up with a creative spark. I mean, I think my good friend Dave Morin had a great line on this, which is like, great VCs are editors, not authors. And that's kind of what of the future, and that's kind of what PhD advisors do really well. To help you edit the idea and then force you to, okay, that seems cool to work on. Can you realistically, given the constraints of the world, can you prove it, right? And what pieces do you prove that puzzle is correct to know that we're all going? And I was like, that kind of makes a ton of sense. And in Silicon Valley, I think we were increasingly missing that front-loaded portion.
So how do you save then that 3 years? Because on the surface, that sounds like what a pre-seed or a seed round should do for you, right? You should have the resources. You should be iterating on these experiments. You're saying there's actually...
But my point is like, once you commit, once you incorporate and raise...
No, that's what I'm saying is like, but I think the distinction you're making is, but you've now committed, whether or not you were right at all, or whether this is even worth pursuing, you're now committed to pursuing it for 3 years.
It's like getting grant funded by the university before you even figure out what the dissertation is. And so it's just like an ordering problem, right? And there are people why does Sutter Hill incubate really well? Because they go through this process. GP goes and lives and breathes the problem for 4 to 5, you know what I mean? Like they go get that level of depth and spend time thinking through the feasibility, like arcs of history, feasibility, and the businesses associated with them. So like, I think there's precedent for this work. We just went through a period where it kind of decoupled a little bit. So the idea becomes, but listen, people can build whatever. This is not our idea. This is not incubation. Do whatever you want. But I think it's trying to create a process to hold up a pretty honest mirror or reflection for what founders are saying. About like, here's what you're saying you're going to build. That's either a place you have domain knowledge or you don't. That's a different odds profile, right? You're talking about something that's like, and you keep playing it out. You're like, that's not a novel arc of history. Everybody's chasing that. That's fine. You can, you know what I mean? You can start teasing out where you are on the curve and then play it all the way out of like, great. You think maybe we can whiteboard this, but like you figure out how the world works, then you figure out what needs to be built. You know what I mean?
You're a big guy.
This is going to look very funny on camera. Are we going to be able to
make this? I actually love the scale of this.
Yeah, I think this is what makes it go viral.
This is actually what makes it go.
So the first insight we were talking about, right, is figuring out, is there any shot at a big, credible, independent business? Can we even a couple plot lines? Can we draw some credible plot line from here to you having enough scale, girth, predictability to talk to the public.
And that's either somebody who looks like you or some some possible future where the market here, just like when Facebook started on Harvard campus, you could project forward and say, okay, we take this to other campuses, we take this off. So it's just an imagination.
Following an if-then statement that's like doesn't have leaps of fanciful wisdom where you go from like 30% gross margin product to overnight 90% gross margin product, right?
Okay, so in this one then,
we'll get to how we like put the top of the funnel idea, but like, so the idea was you're pitching me on something, right? It's already narrow. It's like, I mean, I would say most cybersecurity companies, it's very hard to credibly map this out, right? They're ending up building a product that's going to run into distribution problems. The history of cyber companies is even the successful ones get bought by Palo Alto for $300 million.
Okay.
Right, so like history can be a guide with what we're talking about. And some businesses don't have the forecastability or the economics, right, to credibly, I mean, you're invested in a couple that went public and so am I, that have had a hard time in the public markets. So anyway, it kind of starts with, can we at least imagine? And then my theory became, all right, that's just some number of hypotheses that have gone right. You don't actually work on the end state of the business when you aspire to be something. You break it down into bite-sized pieces of like, we're Airbnb, we're gonna start with rooms, and we're gonna take houses, and we're gonna go in and we're gonna add services, and if we do all those things, we look like a credible competitor to a hotel, right? So then it becomes fun. In this, you kind of dream with the founder, like, what's the big thing we're dreaming about? Cool. Let's like beat that around to see if, and then great. What are the other things that have to be true? Pretty quickly put that on the line. And then what gets fun on the knowables is like, cool. So these are the first 3 hypotheses, right? Like it's kind of like, all right, these are the problems you go after. As soon as we have that, we're like, what product or series of products are we going to build? Once you have a product, you can really have pretty tight theories on the value prop, right? You can really, is it quantitative? Is it qualitative? But like you and I can pretty quickly, you know what I mean? If you tell me you're gonna make a shoe, we know that's a qualitative value proposition, right? That's hard to quantify it. And we know that my favorite part of TAM is just spend on the problem. Your TAM is actually like, you're solving a problem. What was spent last year? Because a lot of this is teasing out how many things we're going to invent.
Right.
Or how many like novel theses we're going to back.
Okay, I love that. So that actually gets around the like, if I'd asked people what they wanted, they would have asked for a faster horse. Meaning like, there was like,
you can build a car,
there's real invention here in terms of like, it doesn't exist, or only an opaque idea of what this future looks like exists, but it doesn't mean we shouldn't pursue it.
Yeah, let's just be honest, right? Not only do you have to be right about a novel product thesis, you also have to create spend. And so now we're just trying to really figure out like how many unsolved mysteries or how many really novel things are we betting on? And then, so value prop, and you actually need to do it absolute and relative. Right? So what's your absolute value prop? But that only matters. So
what's the distinction?
If you and I have competing products, right? I offer $1 of value. You offer 95 cents. The idea is it's pretty cool to offer someone $1 and be able to charge 50 cents. If someone else is charging 50 cents and offering 95% of value, we're kind of going to be in a dogfight. It's going to be really inefficient sales and marketing, right? Which is going to tell us a little bit more about like how big a slog it's going to be, how inefficient it is, how much of your business model is going to go towards sales and marketing.
And again, none of these on their own are disqualifiers.
There's no disqualifiers. Right? It's just trying to get like the honest mirror of what we're talking about, right? So then spend. Is there any moat? I mean, people debate the moats exist. Like they got us in some degree for some little while. So, but like there's only 5 or 6. You know what I mean? It's not like infinity mode. So once we've called out what we're building, we can have a sense of, is there anything we can do to defend it? And then you kind of get like business quality. Is this something that's like super equity efficient, creates free cash flow fast? Are there a lot of margins? Like where in history would all this tell us, right? And then
do you, in your equation or in your framework, do you weight any of these higher, lower, more valuable than others?
No, it's not nearly that like scientific, right? But it's a way to tease out.
Bro, if you're going to call it a PhD.
To get PhDs in literature too, right? And then, all right, if we're just doing this like as 2 friends doing this, and who knows what shows up on the internet?
Yeah, nobody else is going to see this.
I end up with each thing we're going after. You kind of red, green, yellow enterprise value. Right, because some shit you need to do. You got to build a column, and sometimes it's going to be red. Right, sometimes you got to do a thing that's low value to do a thing that's tremendously value. Let's know that. Right, and so this never ends up being perfect. Things change, but at least starts like creating a common language and framework to go through and go like, yeah, right. And what I like, this is like my old theory, like I don't think this is that far off from like the checklist any great investor uses. It's just the amount of data they're willing to back on, right? At Berkshire Hathaway, they want like 20 years of history on everyone. They only want high quality businesses, 20 years of history on everything else, and they want it mispriced.
Yep.
Venture, part of it is like there's going to be a novel theory in here or two. Otherwise, there's not going to be the kind of if there isn't, not going to be the kind of returns we need. So you can start going like, all right, I don't know. I pretty well understand the problem. Product is usually if there isn't a novel take on product, we got some other stuff to figure out. Value prop is pretty, like there aren't that many novel value. Like that's pretty knowable. I would say these spend on problem.
Yeah,
right.
Makes sense.
These kind of become the things you end up, I end up clustering around like, where are the really novel hypotheses we're going to have to experiment really hard to prove to be true? And if they're true, like, how valuable is it to us? And then you go, okay, great. And then if you're right about that, you can kind of ask yourself the same level of questions. Right, and this is where the knowables come out, in my opinion. Of like you can take a big idea, you can take I want to start here, and you can start putting it together and go like, oh, that's like a really tough. That first thing you're proposing is like a really tough business model. There's no free cash flow. It's going to consume capital for 5 years before it kicks off any capital. Right, like we have precedents for that stuff.
Totally.
And so you can be like, great, now you know that. You know what I mean? Like, what is the right way? One, do you want to do this?
I was going to say the interesting thing. To me, at least in the exercises, for the entrepreneur, if the end state is S1, filing to go public, that's a really interesting test of a founder's ambition.
100%, right? Like
because then, if your answer is not S1, calibrate, and then that goes. We'll get into more of like what your relationship to the financial markets are if that's not the end goal for you. Right? It doesn't mean not to pursue it. Like you said, none of this
is disqualifying.
Right.
It's just being honest about the DNA of what you're going after.
I feel like it gives you a real framework for navigating the idea maze stuff. Because this candidly, I mean, what I hear from you, from what we heard earlier, was like, this is the work you should be doing before you come into my office. Meaning, like, before you go to pitch an investor.
Yeah, before you're ready to accept capital, you should have tighter than everybody.
Yeah.
And that, right, one of the fun parts of that is if you get really tight, you can identify the right sources of capital and like have a tight thesis on how, not what the outcomes will be, we don't know, but like, and a tight thesis on how you will use the capital. I can almost guarantee you raising the capital will not be a huge issue.
Interesting.
And so this became the framework for building up, right? I mean, we could use it to diligence things slow, you start having net new conversations.
Right.
And that's kind of where, like, so this was like the roots of the PhD program, but then I realized, like, if you were really going to help people, and again, you can see how this becomes very informative of how am I proposing investing my own opportunity costs? Like, what is the investment I'm actually making? How can I, and the other thing I was going to say is, like, you can see.
It also would force, especially if you give yourself constraints, it would force yourself to find more efficient paths to answer these unanswered questions, right?
Yeah, because it becomes the tightest experiment you can run,
right,
to get the most important yeses. Right, so you can identify what are the unknowns, how valuable is each one. True false doesn't exist on a continuum of more being more true. It's like you can reach a pretty, right, it's like statistically relevant, great.
Yep.
Right, and so I do think this can make you much more efficient with your time and money towards proving things that are really valuable. And the other thing, like back to what I was saying about old venture, I think like you really want founders to spike on this. This is the problem, product, arc of history, right? Like those are just the unknowable creative spark things that you want to encourage and like that I don't have. All this is just studying businesses for too long. You know what I mean?
Yeah.
And so you can see how back in the day, this was VC's work was mostly done, right? Like being able to diligence the product thesis and then play out the rest of this. And it was a really nice marriage spending 2 or 3 months to get to a yes, because you as a founder could feel good that this work had been done. And then when that work got shortcut or whatever, like you can see how it left founders a little bit in the lurch for how to fill this graph out. Does that make sense?
I think so. It would be helpful to maybe explore a couple real world conversations or scenarios where you've changed the arc, or someone has changed the arc of what they decide to work on or not work on based on the PhD, the slow PhD, or this framework, regardless of the metaphor?
I think it has ended up being a very clarifying force in the boardroom.
Oh,
right?
Okay. So even post-investment, you found value.
100%, right?
Okay.
Because it basically becomes like a shared investment framework, which I think is like one of the
So a touchstone you can go back to all the time and say,
we thought this was true, right?
Yeah.
And we either, is this more true, less true, right? And I think it can also take you out of number go up mode, right? Where I think a lot of companies can get into trouble, which is like chasing number go up, but not necessarily proving really important things in their business are unassailably true.
What's an example of number go up that actually ends up being net negative to the business?
Without using names, I'll tell the positive version of this story, which is like, there's a founder in our portfolio who wants to raise a little bit of growth capital, and I have a hard time with growth capital, but like, only that I think people overemphasize, like, you don't need to grow 400% every year, right? If you're doing something proprietary, like, grow 200% more efficiently for like another couple of years. But he didn't, the positive version of the story is like, he didn't understand how ROI, right? He was chasing sales, wanted sales growth. He didn't understand how ROI positive his sales force was, right? Because
what was he not seeing that you were? Or that
he hadn't broken it down into the unit, right? Like, so the unit analysis of like, oh man, yes, because it's overlapping J curves, right? So, and I think the negative version of this is like, people can overinvest in sales with declining efficiency, revenues going up, right? But the overall economic equation of the company might not be keeping pace.
Yeah.
And then listen, people are like, it rarely is this like totally hidden, but I think you can get away from, right? You can start chasing increasingly less economic growth, right? Versus being like, oh, we know how to grow it, right? We know what the economic equation is for an entire, from production to sales. That economic equation works, and we can throttle it up and down at our own.
Okay, so this reminds me a little bit of Eric Paley's 55 tweet.
Yeah, which I tweeted as a must read.
Opus. So does that intersect with what you're talking about here? Like, is there overlap with kind of the framework you have and the thinking that went into that? Maybe you could distill down what he said that made it a must read.
It's a good, I mean, I think it's one, I just think any content from really smart people on being an allocator as a founder, which is really what it was saying, is like getting much sharper on allocating human and financial capital as a founder. At least that's like my interpretation of it.
I love it.
And being aware of the returns on that capital, right? I mean, that was the like root of the thread, is like, do you have a positive, like, you need to know a lot about, unfortunately, I mean, again, my line is like, I think founders need to be the best investors in their own company. That can be a learned skill, but like, they need to be the best investors in their own company. So I think one thing he's hitting at is that general theme, which is like a must read, because there's not enough content or pushing, right, for founders to go that way. You know, so Paley hits on a thing that I guess the way I've said it.
Get up there.
Get up there. Back to, we had a couple different hypotheses, right? So he kind of had this idea that there's like declining margin at a certain point in any of the network effect or any of the cycles the investment cycles you kick off. And it's like, kind of like you create a value in the world, right? And it kind of either gets fully priced by the markets or arbed away pretty quickly is a little bit of how I read it. And so what I've always said is, if we go back to our hypothesis 1, 2, 3, and N, right? If this is going to be the value of the company, so this is one, like, it's not true at all. We generate data. It's true. A ton of the data accrues just from, right? From like no data to true. Less data, and then you replicate it. Like, there's some more value that comes from being able to replicate it. But once you
replicate it, what do you mean when you say that?
Keep getting the same outcome, right? Okay. So I've proven my profit. I love semiconductor companies. They're like the cleanest thing to talk about in venture, because if you were right, it was like 10x better, 10x cheaper, great business models, right? So it's kind of like, hey, I have a novel idea for how I can build a semiconductor that's 10x faster. Oh man, I did it enough times that it's probably, like, it's true, I can run it.
Yep.
Now I've shown what it takes to run 1,000 of them off. There's no reason I can't do 1,000,000. Right? And so very quickly, all of that gets priced in, and that kind of becomes the curve of the company.
Yep.
What's fun is when the company then has a net new hypothesis, right? And can start testing that out here. right? Oh, that hypothesis is true. That asymptote's out, right? And you kind of you can stack. Stacking S curves is like a very known thing, but this ties it to actionable thesis that you can diligence, right? So what does some version of the derivative look like? Hockey stick valuation growth.
Yeah.
And so I think what I read beyond like everyone should be reading more as founders of like as capital allocators, there's a little bit of this. Let's saying a little bit of this of like you do a thing, and even if the economics are really good, pretty quickly they asymptote out. Either valuation-wise, because everyone gets it and gives you credit, right? Or the market figures it out. And so you need to kind of be aware of where you are on those curves. This is totally unrelated. I don't know if we use this as a soundbite, but we kind of threw out the license and maintenance business model pretty unnecessarily, in my opinion. And like Larry Ellison still owns 40% of Oracle. You want to know why? Because the cash conversion cycles of license and maintenance models when you're in a growth mode are wildly more efficient than when you're in a SaaS mode.
Yeah. No, I mean, we talk about that a lot. Time to revenue. Time to like recognizing revenue, cash cycles. Like, it's something that I don't feel like we talk enough about.
No.
Because it's such an enabler for all kinds of different businesses and all different kinds of growth.
And it should just be on the table, I guess, is my, you know what I mean? And I think that's where like having a tighter thesis on the investment from a founder lens, being aware of capitalization patterns, options, like needs to be on the table. And I get why it hasn't been. Which is for so much of Silicon Valley's history, the business model was so wildly lucrative, right? Like when you were dealing in like deeply technical IP modes that had like 99% incremental gross margins, it really was being right about the you know what I mean? Like nailing product and having a team who can go to market was the thing. You didn't have to worry about the business model. But now that we've gotten into the application of technology as much as anything, I'm not sure it's as easy to like not pay very close attention to what we're talking about in terms of capitalization, business model, et cetera. And frankly, those companies didn't have access to tons of growth capital, right? You could do a thing, but then you really, like there wasn't 300 million of equity to rely on. And so you went into these patterns of like, I'm just gonna grow 60 to 120% for 10 years, not 500% in 1 year.
And that was acceptable back then.
And healthy, right? I mean, super healthy.
Not acceptable today.
Which I don't, yes, it seems to be. I don't understand why. It seems like it should. Like, I don't know why you've got to pull all the growth out of the business, you know what I mean, in its first 3 years, and you can't grow. Again, why not grow profitably at 110% for 10 years?
What's your answer to why, though? Why isn't that encouraged more? Because we certainly haven't.
What's your answer? I've been doing a lot of talking. What's your answer?
That's the whole point of this. You're the one. I just get to turn the mic around on you. No, I mean, you know what my answer is. My answer is what we're doing with Indie. You know, it's
why isn't it? The Indie's an option, right? But like, how did we end up here?
I think a few different things. One, capital was so much more abundant. And it became, from an investment standpoint, it became a very lucrative business model in the sense of, you know, when we started seed investing in 2005 at OATV, there was this idea of optionality. This idea that, A, we don't know if it's a feature or a product or a company. We're gonna like iterate and experiment because it's cheap enough to be able to do that. And there were all these different paths that you could go. You could build a profitable company, never raise again. You could sell early. Like those were the days of like the Flickr and Blog, all these acquisitions that were going on in the kind of sub $100 million range, which as a small fund with a large ownership stake could really move the needle. You could see kind of venture type of returns even in those smaller acquisitions in terms of a multiple. But from a business model standpoint, it was way more lucrative to have a hot company that raises from other firms. And so pretty quickly, those two other options became far less attractive to both your seed investor, whose now main job, full-time job, is to get your next round raised. And for entrepreneurs, it became this like perfect product of offhandedly say and probably inappropriately say that like venture became daddy issues with the business model. Like it tickles all those parts of validation and ambition and all those pieces of someone who's really putting themselves out there, feeling incredibly insecure about what they're building. It gives you validation. It allows you to talk to your family in ways that you couldn't otherwise. You look legitimate when you have venture capital on. I would say some of those were real factors into kind of what changed it. And then there was just so much of it.
Yeah.
And I think you and I both know a lot of legacy firms were built on the backs of just unbelievable returns. They owned massive chunks of these companies. The economics of venture were like so compelling when it worked. And there were so few entrepreneurs that the signal to noise ratio was wildly different. Enter, Web 2.0 and all this kind of flattening of, cost structures and ability to, build and scale companies. And now everybody wants to, then, the social network comes out and suddenly an entire generation doesn't think $1 million is cool. It's got to be $1 billion. It's just like culturally it took on a whole different meaning and in that meaning was a lot that made it wildly aspirational, not the least of which that a lot of people were getting rich doing it.
Yeah.
And so, I think it was that maturity of it as an asset class that made it far more lucrative to be pushing dollars out the door, not indiscriminately, but certainly in fairly tight boxes and patterns to match against. That suddenly we went from 5 seed funds in 2005 to 5,000 seed funds now, but I don't know. Does any of that resonate?
Yeah, no, that all totally resonates.
That's also why I let you talk and not me.
Unprofitability lack of profitability at scale. There's a chicken and egg, which I don't remember which companies, other than Uber really being the first, right? Where as an investor you got really rewarded
for sure
for firing.
And Amazon too. Amazon was one of those where people would point to and say they lost.
Well, but so maybe Amazon started it because Amazon was really. It took me a long time, right, to get around, because it was the first one who said. Adhered to the Buffett Munger take of net income is a made up. It just comes to show me the free cash flow, right? So
totally.
Amazon probably was the first that broke people's brains because it had a ton of market cap with no earnings, but a ton of free cash flow, right? That they used in order to run S curves,
that's right.
Invest in S curves as well as double down on the scale of their big business, their core business.
When it was also one of those where I think it gave people the false perception that you can be profitable anytime you want to be profitable. There's a profitability switch in the back. Just run back there when you need it, right? And just flip that sucker.
Because you look at a lot of the other names. I don't know if you go back and look at Google's S1, but Google's early years are wild economically.
How so?
I don't remember the exact numbers. People can go look them up, but astronomic growth with astronomic profitability and free cash. It just once they made the AdWords acquisition, it was just
gone.
Right.
Yep.
So maybe Amazon was the first one that gave people an excuse to not be profitable, but people missed the nuance because it wasn't talked about enough. They're guys, but they're free cash flow positive, right? There's no accounting profit. But they're funding growth not out of equity, right? But out of a very clever business model that allows them to get to a lot of scale and at some point turn the corner on their core and make net new investments that have paid off wildly, right? I think maybe that's the first one. There's got to be a couple SaaS names I'm missing, right? Where they did pursue on net income negative growth and then come out the other side with a ton of EBITDA. But I think that's the other. I think there were just enough.
Do you think that's
there were just enough case studies to right, to marry the capital interested in the space with desire to manage more capital with and we can be unprofitable. And I think maybe we just chased that plot off a cliff.
I think that's probably right. I think it's much easier to be unprofitable than profitable, which seems obvious. But I remember in the early days of Indie talking to someone who'd done startups, been a senior exec at a bunch of big companies. He was probably 30 years into his technology career and was just coming to terms with the fact that he had never worked for a profitable company in 30 years.
That's wild.
I
wonder how much it has to do, or at least there's a strong relationship with decreasing value proposition of products. And what I mean is an increasing amount of products that have qualitative value.
Yeah.
Right. They save on time. They save either. So the way we break down one of the ways I break down, I shouldn't always say we, like this could be a very Will specific approach, but like, is it qualitative or quantitative?
Yeah.
Right? Is it vibes or CFO numbers? And is it causal or correlating? And all can be great businesses, right? So like qualitative and causal is like a handbag. There's no reason it should have value, but it does, and buying the handbag creates the value. I think quantitative and causal, I always use AdWords. It's like, oh, I spent money on AdWords, I got more revenue, that felt good. Like it's a very tight.
But I also feel like that connects a bit to the second hill you're dying on, which is what is venture capital? Because I do think part of what the maturity of the asset class means is it becomes meaningless as an asset class.
Yes.
Why does that matter? And how should that be trickling down to the decisions entrepreneurs are making? Once they've gone through the idea maze, once they've done your framework, once they've figured out this is something worth pursuing, how should that inform the kinds of capital they seek? And then, there's a part of that that's like, maybe that's just a very high class problem to even think about the fact that you may have multiple capital sources that you could pull from.
I'm not sure it matters what the technical definition of venture capital is. It matters to me.
You heard it here first.
Yeah.
It actually doesn't matter.
It doesn't. Nothing matters. We're all going to die.
All that time you spent on Twitter eye rolling at Will's tweets when he's saying like, what is venture capital?
We'll just start there. We're all going to die. Nothing matters. But one, why it matters to me is because like I'm trying to do it really well.
Yeah.
And so I just believe if you can get to the root purpose of a tool, you're probably going to use it as, you're going to use it at its best uses most often.
So as you sharpen that tool or you define, and we're obviously using it metaphorically.
We haven't even gone to Will metaphors yet.
No, but like, how does being precise on the definition inform your practice of it?
There's a great book by Mike Mobison called The Success Equation.
Yeah.
And the long story short, it's like almost everything in life is either dominated by luck or dominated by skill, and it's important to be able to deduce it because if you want to maximize your odds, what you work on is wildly different, right? And short story, skill-based games, you work on the skill. Luck-based games, you work on your decision-making framework, right? Because you don't control the outputs, and there's so many variables that if you're also varying how you make decisions over and over again, you've just entered another variable instead of making one constant. It's like why the book exists for blackjack, right? It's like a decision-making framework. It doesn't mean you win, but it gives you a process that at least gives you an edge. So I think for me, like getting to the root of, in general, what is good investing, right, across asset classes, and getting to the specific roots of like, what is the point of venture capital? How has it been, how has it been used really well over history? And I think for me, it gave me a little bit of like a book of blackjack for me to more quickly and consistently read the cards on the table when presented with an opportunity, which I think for me gives me more comfort in my ability to use that capital to outperform.
Okay, so what's that, dive into that. One would be like how much of venture is luck and how much of it is skill?
It's all entirely a luck-based game. Investing is a luck-based game. You control almost nothing. It's inherently a luck-based game. So the question is, what really intelligent decision-making frameworks and processes can you use, right, to give yourself some edge at the table?
Okay,
and for me, part of that is really understanding how has capital been used to perform like venture capital, both for founders and GPs and LPs, and trying to get to a root definition, right? And I think what it helps me do is say no to things that clearly don't call for it and have a much more critical scalpel for things that appear to call for it.
How has what calls for it versus what doesn't call for it evolved in your time? Either it's slow, but you've been a participant in venture for the better part of,
I don't know that it's like, I guess like the real dogmatic Will's response is like, it's never changed, I'm just discovering it, or something like that. You know what I mean? Yeah, I mean, but like that's my honest viewpoint is like, I'm not sure.
It's really what you're saying is just vibes. No?
No, it's, I guess like my joke about everything as a semiconductor company kind of plays out like this. Like
That's a terrible joke, by the way.
Why?
Because it's not funny.
Why? You're laughing. You're laughing. Which is like very funny in the right context. What are the inherent characteristics of like what calls for venture capital?
Yes.
And I think for us, there's a couple, like it's a tight box, which is like novel hypothesis about how the world works that you can prove true or false. That is like wildly valuable if true, doesn't cost that much money to run the experiment, and that experiment gives you the call option on being something else being true. I think to us, that's like the purest form of the box. And like, what does it encounter in there? Like, well, it encounters novelty, right? So some unknown involved in there. It importantly like allows you to get signal, right? It's not just like directions and lines. It's like, oh, that thing is like declaratively true. You gotta have call option, like it's gotta be valuable. And then the lack of equity gets to equity efficiency. You need to own businesses that can build value, heavy equity lifts relative to the end state value. And so I think that becomes like the tightest definition I can find. And now listen, does everything always present that way super tightly? No, but like, does that at least give you an aspirational framework? And if you want to concede certain levers because either you're comfortable with it or whatnot, I think there's lots of models that work like that. But at least that to me is like the purpose of venture capital is to run that experiment against that box. I mean, like from a like you want to keep doing this. Like the returns come from owning just killer businesses that kick off free cash flow, grow. What has Amazon done really well? But even stuff like they reinvest the capital really well too, right? It's like you kick it off and you know what to do with it. Like that's, and I don't know how we lost such sight of that. You know what I mean? And so I think it's also kind of fun to take like definitionally in venture, like you need to end up owning.
Because if that's not the definition, or if that's not what we think about, how do people talk about it today that's different than owning rad businesses forever?
Probably unspoken dynamic of like, oh, with a good enough product at enough scale, you will be a rad business. And I think we now have enough temporal data to look and be like, that isn't always true.
Yeah.
Right? It doesn't necessarily.
GoPro at 250 million.
The market cap, right? Things like Nest, which were like, I don't mean to pick on hardware, but like wild acquisition, not a great P&L. You know what I mean? That business wasn't like high growth with EBITDA.
Feels like there's like Bermuda triangles of venture capital that it enters and doesn't leave. Hardware might be one of them. Are there others? And you know, maybe hardware isn't one of them.
That are just irrational for venture capital.
Yeah, just straight up shouldn't be raising venture capital.
Again, I like no big generalizations come up, but a lot of times.
But I've heard you talk about hardware a few times. Yeah, we've had mention of hardware. Like Dempsey on his episode. You know, when we talk to Dempsey, he's like, it's our projects. Like no one, you know, like most of these new devices aren't going anywhere.
Yeah, I mean, I think the hard part I've always had with hardware is one is the equity efficiency in general, right?
Yeah.
In general, to stand up that new hardware is really expensive, and so on doing the box, that just means that much more value that it needs to create given the equity it needs to run the experiment. I think the second thing is like rarely anymore is the hardware wildly proprietary, right? Where they're like, no, this is proprietary hardware and this is where the value is going to come from, right? Mm-hmm. And I can show you in that box, I've got a novel take on hardware that I can prove to you generates value in a very true or false way. Mm-hmm. It's wildly valuable, right? Like that box is hard because wildly valuable is hard with margin structure. It's a lot of cash. So even for the ones that fit the box, it's tough. And then I think the other part that's just always wild to me is they're like, okay, we're going to build hardware. But I'm not going to tell you that it's defensible. But what is defensible is going to be our software-based business model, right? It's going to be the data we collect. Right. It's going to be, and you're like, okay, let me get this straight. So we're all going to go on the hook for 25 to 30 million bucks just to get to the point where we can run the experiment on the subscription-based or data business model. Right? I mean, that's effectively what a lot of them are asking.
Seems like it, yeah.
And you're kind of like, okay, but I also have the opportunity to like put 2 to 3 million bucks in something with the same business model. You know what I mean? I could just go do a business that's going to do that on day
hardware free
on day one. So again, not saying don't do it, not saying there aren't great successes, but it's been an interesting counter positioning, I think, for a lot of the people frustrated at the lack of venture for things like hardware. They've just got some DNA to them that I think makes it hard to fit the box.
So yeah, that's what I'm trying to get at is what's the DNA of the venture capital Bermuda Triangles consumer products?
So I think
you had a big wave of makeup and eyewear.
I think so. Qualitative value propositions in general feel a lot like art to me, right? Where you go far enough out the curve, like the value is very subjective. It's in the eye of the beholder. I think there's a reason millennia, day zero art has been funded by patrons that don't have a profit expectation, that like just want it in the world.
Yeah.
And so I take a little bit of signal from that it's like hard to craft consistently a investment thesis on day zero of art. Now, what I think can be wildly valuable is like, oh man, you sold 30 paintings, or like, you know what I mean? That you've launched and that resonates with people. We all don't know why, but people find your shoes really valuable.
Yeah.
I think then you can start building a thesis, or the unknown is, hey, do those 30 people look like 30,000 people, right? And you can maybe make a more informed. So I think I guess my point would be, I think there are venture moments in a lot of businesses, right? At which point the box logic is filled. I don't know that it's always at inception. And I think for consumer businesses, it might be that the venture moment is actually post-launch, not pre-launch.
I think if you look at the most successful consumer product businesses, that's correct.
Yeah, the NPV positive place to jump in with capitalist money was like, not that they were going to make something that would resonate with a lot of people, but like, oh, this is resonant. There is the market. You basically need the market to signal that the product is valuable.
Yeah.
And then you need to bet on how big the market is for those people, or for that product.
Yeah.
I think is like, and it's a very cold and calculated, not fun way of thinking about consumer products, but I'm guessing that that's probably the right trend line.
But it also speaks to kind of the broader blunting of the definition of venture, which tends to be like, can this be used to be $1 billion company. Now can it be a $10 billion company? So when a founder comes to you and says, I want to raise venture capital, you run them through this exercise. How do they take it when you tell them you shouldn't raise money?
I think if it's someone who's already pot committed and like incorporated and going, it's like,
we'll go raise from somebody else.
No, yeah, it's a hard conversation. It's like, I think you learn to have that conversation deftly of like, hey, it's just my opinion.
Right.
You know what I mean? Like, this is one crazy man's framework.
Right.
I think for the people that we work with pre-idea, they're like very grateful for that feedback. You know what I mean? Of like, this may not be you may not need it, right? One is like, first you got to dream on the arc of history. Like, go out and dream a little while. Like, that's the creative spark. How's the world going to work in 15 years? That's, I think, almost all the alpha in the markets in general, from founders through hedge funds, is that core insight of like, just how are you convinced the world works on a long enough timeline that people aren't thinking about? Because once you have that structure, what you do about that, what gets built, becomes more self-evident. And then kind of once you pick a layer, an approach to attack, right, as a founder or investor, you can pretty quickly then tease out, okay, how do I work up? Can I just build that overnight, right? Or how do I work up to that? And I think you can get to some things where like, hey, like the core swing hypothesis in this whole thing, you can almost bootstrap. You know what I mean? It's like such a valuable product that takes nothing to build. Like, why would you sacrifice the optionality to go chase down venture capital? So I think that can be an answer. I think you can get things where you're like, hey, it's gonna take like $25 million to flip the first interesting card. And it's not even that valuable. Right, you can go do it, but like that's going to mean, I call it eloning. Like, you're going to have to elon the capital markets, which is like be able to raise well ahead of logical progress.
Right.
And just be, and again, like, no judgment, but like that's probably what you're.
But you're probably not Elon either.
There is cost to participating in the venture capital ecosystem, to raising and misraising, as India's talked about for years. And so I think definitionally it's important for founders to have an understanding, or their own understanding. And I think the biggest thing I'm like curious to see what happens is if you really help founders become better investors in their own companies, what happens, right? Like
What's your hypothesis?
I think it creates like wildly better companies. I think they're more efficient with capital. I think they create higher returns. And again, it's like easy to backtest.
Do you think we end up seeing more of them?
More what?
Great companies.
No, I think there's like I think we've learned that over time, right? We thought that the supply of great companies was capital constrained. I'm not sure it is. I think it's like, you know what I mean? It's innovation constrained, and it's.
You just think that's a
constrained.
natural law. There's only 10 to 15 companies a year that end up mattering.
I haven't seen any. The older I get, the more respect I have for what's been true continuing to be true. So it may break, but I haven't seen anything that like would suggest that. But I do think you end up with a lot more good companies, and the odds of great companies continuing to compound and listen, I think a lot of the best founder CEOs are like inherently really good investors. I mean, Mark Zuckerberg buying Instagram for $1 billion is like
incredible.
One of the best capital allocation plays ever.
Yep.
We kind of over-index on talking to founders is like product. I'm curious if you like go, okay, but product fitting into the overall business equation, and here's how capital compounds. I'm super curious to see what happens to efficiency and outcomes. And I think you actually end up with bigger companies as they begin to understand, okay, it's time for me to make my next bet, right? And how do I finance it? How do I think about it? So I'm super curious. I don't know.
Well, we've literally been going 2 hours, so this is great.
That's amazing.
Anything else you want?
Dude, this is gonna be such a.
This is going to be a nightmare to edit.
Yeah. Oh yeah. 100%.
Oh yeah, it's a.
Did we get some good shit though?
Yeah, of course.